introduce James Vaccaro. It is such an honor. I get the pleasure of working with James every day. He's the executive director of our Climate Safe Lending Network. What you may know about James is that he's a strategist, a systems thinker, and he has an enormous background in sustainable finance. He has over 20 years of senior management experience in sustainable banking and investment, and he currently acts as a special advisor to Triodos Bank. James has served on share offers and bond issues for leading charities and businesses. He's managed equity investments. He's been a non-executive director for a wide range of environmental and social businesses. He is a senior associate of the Cambridge Institute for Sustainable Leadership and was one of the founding developers of the UN Principles for Responsible Banking. He serves also as a member of national and international sustainable finance advisory groups, including Bankers for Net Zero in the UK. So you're with a financial industry powerhouse right here. But what you may not know is that not only is James a thought leader in sustainable finance, he's that rare combination of someone who is a visionary leader, a great collaborator, and someone who knows how to get things done. And most importantly for this conversation, he's the co-author of our newly released paper, Financial Sustainability in a Planetary Emergency, the Role of Banking Regulators in a Burning World. We all have important work to do together in this time of planetary crisis. So please join with me in welcoming James to deepen the possibilities for how together we can work at the scale and urgency that this time requires. Welcome, James.
Thank you, and welcome everybody. I intend to go through quickly the process that we went through in curating this research report. And it really has been a joint effort from lots of input, and I'd like to thank everybody who's been involved from the interviews and all the survey participants, and for you in joining and continuing this conversation through the G7 agenda, where a net zero financial system will be on the agenda, all the way through to the pivotal COP26 conference at the end of the year. I'm going to go through some slides very quickly just to go through the process and the key content. The starting point and premise of our research report was that financial stability is predicated on planetary stability. The financial system is nested in this kind of human economy which lives within society, that lives in the natural world. And whereas in phase one of financial risk in terms of climate, we've done the necessary measures to try and look at how financial institutions can protect themselves from the environmental risks and climatic risks in the world. And that's absolutely necessary. It isn't sufficient in being able to make sure that the world and the planet is protected from the risks and the impacts of the financial system through the investments which are made in the economy every day. So we sort of set out to say, well, if we start with the point that we are in a planetary emergency, what are the interventions, the policies which would be commensurate to managing that risk, the environmental risk and social risks? Next slide, please. We started the research, if you go back one slide, we started the research by asking leading experts through interviews about different proposals that they had. In curating, we've added some of our own content, but these are ideas which have come and been crowdsourced from experts all around the world. And then we asked a blend of academics, NGOs, banks, central banks and regulators, policy experts, investors globally, predominantly from where the network is based in North America, US, Canada, EU and UK, in the early part of this year, to rank the proposals on impact and on feasibility. To what extent would they have an impact in terms of protecting the climate, and how feasible could they be? And we've discovered this latent consensus that exists across this very diverse range of stakeholders. And as Lisa said, it's not about whether you like them or not, it's will these actually work and have an impact. Okay, let's go to the next one and start proposal one, which is something which has started across several economies. So stress tests, it is crunch time for stress tests. The starting gun has gone in the Bank of England, the European Central Bank stress test. The Fed is starting the design of how to integrate climate, and in particular, the Network for Greening the Financial System has set out its scenarios. In this particular proposal, we've said, do they actually go far enough in being a stress test? Stress test is about being able to look at how the system reacts in a stretched scenario. So when you consider that all of the climate emissions going up till the year 2050 don't just affect what happens in the year 2050, they're locking in temperature increases beyond that date. And if physical risk is then increasing beyond that date, how do we ensure that we look at what those scenarios are and have responsibility from financial stability regulators to ensure that we're maintaining financial stability for generations to come? Likewise, looking at faster transition scenarios. What if we were to transition to net zero by 2030? It's not likely. Stress tests don't do likely scenarios, they do stretch scenarios. If it is survivable, maybe policy can go faster. If it's not, maybe we can address how it can be more survivable. Going to the next one, in terms of capital measures and the risk weighting of individual assets, this has been known for some time that this is a major strategic element for all banks in being able to drive their core allocation of where they lend. And a very detailed proposal here in the Climate Finance Doom Loop report by Finance Watch set out how we could amend the risk weightings for the high carbon assets like fossil fuels to rebalance the fact that these are contributing to more systemic financial risk, whether or not that translates into direct risks for the individual bank. If a bank makes a loan to a coal mine, it isn't increasing just its own risk, it's increasing the entire risk of the financial system for institutions who are a long way away from it. And also picked up in our report was the fact that at the moment, under the existing rules, fossil fuel companies actually enjoy lower capital weightings, risk weightings than other assets, including green assets. So there's a major rebalancing required. This came out top in terms of the impact of all proposals which were deemed feasible. Moving to the next one, as an extension of this, looking at the fact that many transactions go off balance sheet, that banks arrange and underwrite, there are no mechanisms for that to be for there sort of be a polluter pays mechanism, which exists in all other forms of the industry, where if you're making a profit from doing something, for example, in arranging some of these transactions, then what is the cost? Which in any sort of non-financial bit of regulation, you would expect that you would be paying someone for the downstream pollution of your contribution. This proposal was based on a flat fee based on the carbon element of each transaction for arrangement of transactions. Moving to the next proposal, this is around something which is very topical right now. We have got, and it's really heartening to see so many banks move so quickly in terms of setting Paris-aligned or net zero targets. And there's a lot of work to do, and it's been from a standing start. And I know some of my colleagues from UN Principles for Responsible Banking have put a lot of work into this. However, without the detail, without the consistency, without a rigorous science-based framework, which is enforced by the right agencies of government, we're not going to get to the point where every bank is doing it in the way which is going to add up to addressing the needs of the planetary emergency. So this proposal was specifically setting out that regulators need to define and enforce what the Paris and net zero alignment means in practice. And that probably means interagency working that Ali spoke to earlier between some of the science-based regulators and the enforcers in financial regulation. Next slide. So taking on the role from banks in terms of what they need to know, KYC or know your customer regulation for tackling identity verification in financial crime is something which is so commonplace. It's just part of everybody's experience of working in a bank. Because financial crime is important and we've got legislation for it. Well, climate is important and increasingly we have legislation for it. So why isn't the KYCO2, know your carbon emissions, from a bank's perspective and from a client perspective, becoming more standard practice? And that's coming into more of the sustainable disclosure regulations. And Slavka may talk a little bit more about that in terms of carbon disclosures in Europe right now. Next slide, please. So this one was, well, what if that doesn't work and the voluntary disclosures don't work? Well, there was a proposal for a non-proliferation treaty on fossil fuel finance. What if you were to just say, there are some institutions who will just keep on lending until they are told not to by law? A non-proliferation treaty is a pretty big thing. It's a pretty big ask. It's had high impact, low feasibility. But when you look at things like the Montreal Protocol for ozone depletion and how much the ozone has managed to actually be healed over the last 20 years, there is an argument for its effectiveness. Moving to the next proposal, one that is quite new, we actually closed the consultation for setting up a bad bank. So the bad bank concept, if you have toxic assets like we had in the wake of the financial crisis, what if you were to preempt that, set up the vehicles beforehand and have something where banks would be putting their assets into a bad bank in such a way that there's a discount for doing that, and a larger discount if you do it later, and a much larger discount for doing it much later. And rather than the bad bank only taking back trying to get maximum financial value return for shareholders, it would be managing as an optimization for a just and rapid transition. Many people were maybe sort of caught off guard by this proposal, although when the day the consultation closed, Larry Fink stood up at an IIF conference and proposed something specifically like this, a bad bank for managing climate risk within the banking sector. Proposal 8 was something which is also highly rated and most feasible of the proposals, creating this incentive for green wholesale lending and refinancing of green credit books. You see already through some of the public banks, like the actions of the European Investment Bank, with 50% of its portfolio now going to be invested in line with green objectives. But this can make a big difference. And also now there is increasingly data available to be able to make this refinancing possible. In Proposal 9, we looked at the wider diversity in the financial sector, and in particular, supporting the just transition. The Communities Reinvestment Act in the US has been highly successful at being able to channel capital into communities to be able to reach the parts a one-size-fits-all financial system cannot reach. By extending and building upon that in other countries to a Climate and Communities Reinvestment Act, we can also address issues of resilience and some of the diversity amongst different specialist green solutions. And then finally, on Proposal 10, looking at fiduciary duty. And if you take to the next slide, look at the fiduciary duty and the legal framework for impact. What is it which needs to be underpinned by the legal system? There are still, across different regulatory parts, bits of contradiction. How can we ensure that this fiduciary responsibility is enacted in a way to be able to incorporate more of that responsibility? I just came fresh from a parliamentary discussion in the UK on this. Fiduciary responsibility does not apply to depositors within banks because it is assumed that, well, they've got information and they can vote with their feet. But as if we've heard, information is still catching up. Then what is it that we have to admit that is maybe caught by scope of fiduciary responsibility? Then if we look to the next slide, the results which are in the report, these are the ones which are impactful, which are above the red line. and feasible right of the green dotted line. You see the get tougher on buffers on the capital risk weightings and policing the journey, defining and enforcing net zero Paris aligned financial system. Those were the two top proposals. We're really interested in continuing the conversation, in refining these proposals. And in the next slide, you'll see that we've got ideas already for where we're going to be taking these on, but we intend to continue to define these with you, to be able to refine them and take them and have conversations. Now that it is on the agenda of the G7, firmly within the COP26 presidency, what is it that we can do in this year to drive effective action? Thank you very much.